Okay, good morning, everybody, and thank you for joining us. We're going to give everybody just a few more seconds to hop on, and we'll get started in just about 30 seconds or so. But thanks again for jumping on today. All right, a little after 11, we'll go ahead and get started. Again, good morning, everybody. My name is Dan Forgus from APPI Energy. Really appreciate you taking the time to jump on today. We're going to try to keep this kind of quick, try to keep it to about a half hour. I know a lot of folks have a lot of duties and wearing a lot of hats these days, so we thought we'd just try to keep this short and sweet. Certainly happy to answer any questions. You can use the chat. You can certainly reach out to me. My contact information will be shown at the end. Or if you're working with the APPI is ready already, feel free to reach out to your assigned energy consultant. We'll be happy to follow up and answer any questions you may have. But without further ado, what we thought we'd do is go ahead and just tell you a little bit about what's going on in the energy markets. This idea of taking control of your energy costs, and we thought it made sense to really just to kind of start with what's going on in the energy markets. So with that in mind, just a quick who is APPI? Hopefully you already know us as a trusted energy consultant. We've been in business since 1996, really since the start of deregulated energy markets across the country. And we work in every deregulated electricity and natural gas market from a procurement standpoint. And we also do, so that's kind of on the minimizing your risk, negotiating contracts with competitive suppliers for both your electricity and natural gas. We also have an entire solutions division where we look to increase sustainability, resiliency, help folks become more sustainable. And we really like to have those two kind of areas of the company work in concert together. So you're not in an agreement that restricts you, for instance, from putting solar on your roof, or you're looking to take advantage of ways to reduce your usage and demand, and that puts you in conflict with your energy supply agreement. So we like to say it's really a holistic view of your energy spend, and really helping our clients make well-informed energy buying decisions. With that in mind, again, we'd like to say we hope to be a true extension of your team. Again, we know a lot of folks are wearing a lot of hats, have a lot of responsibilities. You may not have the time or the energy to keep a track of the energy markets. APPI, we run about 400 RFPs or requests for pricing every month. We like to think we have our finger on the pulse of the energy markets. Again, we don't have a crystal ball, but by studying the past, looking at the trends and the analysis, the analytics behind it, as well as those things that are driving the market up and driving the market down, we can help our clients make well-informed energy buying decisions. And we're talking about energy. You really can't talk about today's market without a brief review of 2022. That was really some of the most volatile energy pricing we've seen in our 26-year history. The chart there in the bottom left, you see kind of a couple things. One, the orange line is Henry Hub, kind of a national benchmark for the U.S. for natural gas prices here in the United States. We track that daily. Spot pricing is really, think of that as kind of cash. I'll pay you cash today. I want you to deliver it today. That's called the spot market. Very volatile. And again, last year was some of the most highest volatility we've seen in our entire history. The blue line is really on the chart there is proprietary to APPI. From our sister division, we track all the offers that competitive suppliers put into the market every day. That really, again, allows us to kind of keep our finger on the pulse of the market. Again, looking at the offers suppliers put into the market, and we track those on a national benchmark basis as well. I kind of point out a couple things about that chart. Really is the main thing is the strong correlation between electricity and natural gas. What we often say is where gas goes today, power is going to follow tomorrow. So you see where the orange line moves up, the blue line moves up as well. A little bit of a lag behind it, but when the orange line moves down, you see the blue line, electricity prices move down as well. So you can see the extreme volatility of 2022. I'm not going to go too much into those major impacts, but suffice it to say the COVID pandemic and then Winter Storm Uri, that's that big dramatic. See if I can get the cursor to work on that. This big dramatic increase here is Winter Storm Uri. That really was kind of mid-continent, real cold snap into Texas. But I often say that kind of sent a collective shiver throughout the energy industry because what it really, some folks said, hey, that's renewables. We got into renewables too fast. Others would say, no, that was really pretty specific to Texas. They weren't prepared. They didn't winterize the grid as well as they probably should have. So a number of different factors, but either way, you can see a very short period of extremely high prices mid-continent really had a dramatic impact on natural gas prices overall. That was really kind of coming out of the depths of COVID. You see those depths low, those lows there. Again, Winter Storm Uri. These next three bullets here, liquefied natural gas, the war in Ukraine, and the Freeport fire, those all kind of go together. That really speaks to the idea of liquefied natural gas. Prior to the invasion of Ukraine, Europe got about 40% of its natural gas from Russia. Germany got about 50%. Once that war started, a lot of folks didn't want to be a trading partner with Russia, so they were looking for ways to replace the gas they previously had bought from Russia. And the U.S., despite us seeing some of the highest prices we've seen in a while, was still relatively cheap on the global stage. So there was a big impetus to really import as much natural gas from the U.S. as possible into Europe, or conversely, for us to export as much as we can. There's about 7 LNG terminals operating in the U.S. today, plans for about 13 more over the next few years to be built. And that's really going to keep this demand for relatively cheap U.S. natural gas pretty high. Again, for about the last year, we've been exporting pretty much to our maximum capacity as a country. So, and that's really going to probably continue for a while. Things have gotten a lot better, but there's still a strong underlying global demand for relatively cheap U.S. natural gas. The Freeport fire, the second largest LNG terminal in the U.S., is called Freeport. They did have a fire and explosion in June of last year. That knocked that plant offline really till about February of this year, till they were back at full production. And that kept about 2 BCF a day, 2 billion cubic feet a day of natural gas available here domestically. So that did help suppress prices despite some of these high prices we see. That was putting a bit of a cap on it. To give you some perspective of how much gas we're talking about here, the U.S. pulls about 100 or 101 BCF a day out of the ground of natural gas. We drill for that. We generate about half of the year. We put it into storage for next winter, and about half the year we withdraw it. Again, we drill for about 100, 101 BCF every day. Of that, about 20%, 18 to 20% goes overseas. That might go to pipelines to Mexico and other countries, but primarily about 14 BCF a day goes to LNG, liquefied natural gas. If you cool natural gas down enough, it turns back into a liquid, very stable, very dense, and I can put that on a tanker ship and send that to an overseas market. Might be Europe, might be Asia. And again, when you saw this high price premium for gas, particularly in Europe last year, and producers were really incented to send that gas overseas. Again, the Freeport fire kept a couple more BCF a day available here, kept prices a little bit lower than we would have seen. But what really happened then, and that's kind of brings us up to current day, and that's kind of that drop you see at the end of both the charts there, is we really didn't have much of a winter. It's kind of the winter that wasn't. At the same time as commodity markets often do, we had a lot of gas producers rush back into it, taking advantage or trying to get a piece of those very high prices from last year. So we had production really come to some all-time highs and set some records at a time when we didn't have a lot of demand. It really wasn't a harsh winter. And that's true not only for here, but also in Europe as well. It was a pretty mild winter. So storage levels, inventories were able to really increase. And we talk about weather here. Again, weather is really the single largest driver of near-term natural gas prices. So as I just touched on, we didn't have much of a winter. Summer is off to a pretty slow start, at least here in the Midwest. I know our friends in Texas are very hot, and we're starting to see some of the initial bursts of winter heat, or I'm sorry, of summer heat. But again, not much of a winter, and now summer's off to a little bit of a slow start. So we're seeing a much better news story in terms of electricity and natural gas prices. And you can kind of see here right at the end, they've kind of tailed off. I think we've kind of found our floor. That gas of probably 225 to 250. I think I saw earlier today it was up around 264. So I think we've kind of found that floor, and power prices have kind of leveled off as well over the last month or so. But again, there's kind of always some market factors of things driving markets higher and then driving markets lower. Touched on a few of these already. The things kind of underlying driving the market higher is the U.S. commitment to supplying Europe with liquefied natural gas on an ongoing basis. Again, their inventory levels have improved as well. So they're in pretty good shape heading into next winter. But without a doubt, Europe's energy crisis is not over. And if we were to get, let's say, a abnormally hot summer here or in Europe, or a real cold winter, it wouldn't take long for these markets to swing back out of some balance, putting more pressure on again, relatively cheap U.S. natural gas. Declining rig count. This is just kind of the start of this, but what we're starting to see is some of these exploration and production companies in the U.S. starting to scale back their operations. When prices are high, there's a big incentive to get back out into the fields and drill more rigs and complete more rigs. But when prices are lower, the incentive kind of goes away, and we're starting to see these drilling companies practice a little more financial discipline than they have in the past, be focused on doing dividends and returns back to their investors, and being a little more cautious in putting more rigs in the ground. So we're just starting to see the early indication that some of them are scaling back in the number of rigs. We'll probably see that those production numbers fall from the 101 BCF a day that I just mentioned over the next few weeks. There's usually a little lag there between rig count and production. So it'll be interesting to see how that plays out over the course of the summer. The energy transition, really, a good example of this is just the fact that a lot of coal plants are retiring at the same time that renewables are coming on strong, but not necessarily always ready for prime time, if you will. As they say, the wind doesn't always blow, the sun doesn't always shine, and where it does isn't necessarily where the population centers are. So as the country moves towards that transition towards renewables, it's going to be a little bit of a rocky road. Again, a lot of coal plants are shutting down at a time when renewables are coming on, but it's this transition that we'll see a bit more volatility. Ultimately, the Inflation Reduction Act should drive renewable prices lower. But in the meantime, again, kind of a rocky, turbulent road here. A lot of good news, though. If I had had this conversation a year ago, we would have been a little bit more gloom and doom with the high prices we were seeing. Things have definitely improved over the course of the last year. I touched on earlier natural gas storage inventories. As a country, we drill for gas and then put that in storage for about half the year. We withdraw it for about half the year. Natural gas inventories, the market always looks at two things. How were we at this time last year? And how are we at compared to the 5-year average? So that chart you see there on the bottom right is our natural gas storage inventories as a country. We're well above the 5-year average. In fact, we're really near the maximum in terms of the amount of storage that we can have heading into next winter. So we're in good shape here. Back to the chart on the lower left, though, again, that's our future LNG export capacity. So in late 24, some additional facilities will come online. Additional ones will come online in 25 and beyond. So, for the next year and a half or so, things are pretty status quo in terms of LNG, but you can see here plans well out into the end of the decade, additional LNG and export facilities coming online. Sorry, I overlooked that chart there. Natural gas production, back to the driving prices lower. Again, we've talked about this. The high prices of 22 really incented a lot of drilling activity. What remains to be seen now is how much that activity tapers off when you start to see lower market prices. And again, a warm winter and moderate early summer temperatures. We touched on those as well. So we'll keep moving. Talking about the summer, though, we're heading into the summer months, just about to the summer solstice here. And you may, if you're keeping track of this, you may have seen a cooler looking forecast for the summer from our friends at NOAA just a month ago. That the forecast has moved decidedly warmer for much of the country. We always look to at the East Coast and up to Mid-Atlantic, a lot of the population centers. So again, what they're saying here is above average percentages of the likelihood of above average temperatures. The other part of it is the seasonal precipitation forecast. Precipitation plays a role in a couple different things. One, I mentioned up top, when you have higher humidity, it tends to keep temperatures warmer overnight. So that boosts air conditioning load. Also, if you have a drought or an abundance of weather, you may get more hydroelectricity. So again, this latest seasonal forecast has turned warmer and drier. Happy to say the drought in the Southwest and in California, that's gotten quite a bit better. Had some heavy snows over the course of the winter, boosted some of those reservoir levels. And again, it looks to be a pretty average precipitation summer for much of the Southwest, a little bit lower into New Mexico and whatnot, a little below average. But much of the country is kind of that equal chances of kind of an average summer in terms of precipitation, a few areas of above average precipitation. But again, the bigger takeaway on this chart really, or this page is really a warmer balance of the summer than they were predicting. That kind of ties right in with this idea of reliability over the grid. I mentioned before the energy transition. A lot of coal plants are retiring. You see here, I realize that map is a little bit hard to see, but those are utility scale retirements, not just of coal, but most of those are coal-fired plants that are shutting down. Renewables are coming on strong, but again, we've got a bit of a way to go before that's really a reliable source for utility baseload, that power that runs day in and day out. So we're in this transition period. There are some concerns over grid reliability. That's not just us saying that. Both at FERC, the Federal Energy Regulatory Commission, and NERC, the North American Electric Reliability Corporation, both are saying there's some concerns over reliability for this summer, particularly if we have an above average or really extended period of above average temperature. So I think we'll be fine. The lights will stay on, but there are some concerns over, if we have some of these extreme temperature events, weather events, that there could be some potential reliability issues. And then not the least of which, this idea of upgrading the transmission network. Again, where the wind blows, where the sun shines, isn't always where the population centers are. So we need to move that renewable energy around, and that really comes through the idea of the transmission network, which is outdated and needs to be updated anyways, but then needs to be more aligned with moving this renewable power around throughout the country. So just kind of a little bit of a different look to what's going on in the market from a reliability standpoint. When we talk about utility prices, about 15 states are deregulated for electricity, means you can use the power of competition to take control and drive your energy costs down. About 25 have deregulated for the natural gas markets. So if you're in one of those areas, we'd certainly be happy to have a conversation with you to see if we can help you take a little bit more control, manage your costs a little better than just simply going to the utility. But a lot of folks are still with the utility or are in markets where you don't have an option. This is kind of a mixed bag here. Utility prices, utilities generally lag the broader market. If gas is down today, a competitive supplier tomorrow can change their pricing very quickly. A utility, though, generally has to go through a number of steps, and that's usually involves state regulators. So they put their costs together based on power they bought previously, then they submit that for state approval to charge their new rates. Those often could change every hour, may change every 3 months, maybe every 6 months. But the general idea for utilities today, the prices they're charging today, is probably based on power that they bought late last year in a period of some of the highest volatility we've seen. So this isn't true for all utilities. We have just, for instance, just within the state of Pennsylvania, we've got some utilities that are seeing about a 10% increase. We've got others that are showing about a 40%, I'm sorry, about a 10% decrease on some and about a 40% increase on others. Ohio, a similar story. Most of the utilities in Ohio are looking at about a 10 to as much as a 40% increase. But depending on your specifics, there's what happens at a national level, then there's a regional level, then there's a state level, and then there's even at the utility level. We can help you understand what your competitive options are. If you're with the utility and that's the best game in town, we'll certainly tell you that. But if we can help you manage your costs, budget a little bit better, ideally, reduce your costs as well. And again, have those things work in concert with your particular risk objectives, your financial objectives around, lowest possible cost, least risk, want to go, more sustainable. All those things can work together, and you can come up with a big overarching energy plan and strategy that aligns with all your goals. And that's what we really help our clients do. Again, kind of talks here about the idea of utility prices lagging the broader market, changing a little bit more frequently, whereas a competitive supplier, you may hedge your costs for energy out for the next 7 years, really through the end of the decade, next 7 years. Most of our clients are looking at agreements in the 2 to 4 year range, give you a certain amount of budget stability and a very competitive price as well, but a lot of different approaches to how you buy your energy. What we've been talking about here is really kind of looking back of what's happened in the market in the past and some of the things that are factors driving it higher and driving it lower. This is a different take of it, and we're going to kind of wrap up from a market standpoint. The Energy Information Administration every month puts out this short-term energy outlook. And this chart right here, the blue line kind of to the left here, the solid line, that's what's already happened. Again, we saw that period of high volatility in 2022, and prices have come back off. But when you start to say, well, what happens next? Again, what we take a look at is what competitive suppliers are putting into the market. We also look at what the federal government says, the EIA, that's the blue line is their short-term energy outlook. They put this out every month. And then they also see where the market currently sees it. So we are in this period of pretty attractive pricing, certainly compared to where we've been over the last 2 years. But what both the government, the EIA, as well as the market is kind of predicting is kind of this slow, steady increase that we're really not going to stay in this 2 to 250 range. We're probably going to continue to head up to the $3 range over the course of this year, into the closer to the 4 for next winter, fall back a little bit into 2023, I'm sorry, into 2024. But the idea is, again, the slow but steady incline of where prices go from here. I do think this currently today presents kind of a buying window because the market has been saturated with this gas for the reasons we've already talked about, high production, low demand. Does seem to be a good time to at least consider looking, maybe layering in or hedging some additional forward purchases to take advantage of today's lower prices and really help to kind of the idea of like dollar cost averaging, where you don't get the highest highs, you don't get the lowest lows, but you're kind of always in the market and layering on additional terms, months, years, or hedges, if you will. So the other thing that the government does here is they say, well, this is what we call your upside risk and your downside benefit. They're 95% sure that gas is not going to get back over $10 for next winter, but they're about 95% sure it's not going to get much below $2 as well. And the idea is, do you want to risk the potential upside for the potential benefit of, it could move a little bit lower, but it certainly could move a lot higher. Again, nobody knows where that's going to go, but the stars seem to be aligning for this is a short-term opportunity here to take advantage of some of these lower prices before the general consensus is that both electricity and natural gas will continue to move higher into through the end of 2024. And at the end of 24 is where more LNG terminals will come online. So continued demand from that standpoint as well. What's the impact to all of your organization? Well, obviously, an increase in commodities, an increase in energy spend affects your bottom line. Anything you can do to take a little bit more control of that, whether it's on the procurement end or trying to use less energy, are things that are going to contribute to your bottom line. So we'll talk a little bit about some of those things that you can do, try to reduce your usage as well. But again, the idea of natural gas prices have been extremely volatile. What we also know, although we don't know if prices will be higher or lower in the future, we do know they generally get more volatile as the start date gets closer. And that's really due to the impact of weather. They don't probably know what the weather's going to be like in your area, end of next weekend. It's really hard for them to say what's it going to be in the winter of 2025. So as the start date gets closer, we generally see that volatility increase in energy prices as well. And suppliers and utilities often have either enrollment deadlines or advance notice required. So our big takeaway here is we suggest folks be proactive. Don't wait till the last minute. At that point, you're kind of a rate taker, as opposed to a good energy consultant can help you buy on those inevitable dips in the market. Get to understand your goals, your risk tolerances, your organizational preferences, and then try to align an energy buying strategy that works with that, but with the benefit of having some time for those inevitable ups and downs of the market. If it's not attractive and you've got some time, you can wait. If you wait till the last minute, you're kind of got your back up against the wall. We've been talking a lot about this idea of electricity and natural gas procurement. That's, again, APPIs. We've been doing that since the late 90s, 1996. But again, in the last 5 years, the idea of solutions, efficiency, and sustainability projects has really come on strong. The industry is pivoting in that direction. In both of those scenarios, a trusted advisor is going to be able to help you navigate those waters. And obviously, we hope APPI is your trusted source. We've talked a lot about procurement already. Just a couple things, whether you're with us or with the utility. Are you have favorable terms? Just some things to consider. Are your terms favorable? Are you seeing unexpected charges and line items? Boy, I thought this was one thing. I see a lot of line items with additional costs. Are you hedging against market volatility? Again, these markets, the market I'm sure has changed just in the half hour we've been talking here. Are you taking advantage of that? Are you subject to that, or are you avoiding all that? Is really some questions to ask. Have you secured the best price, best contract length, and then just really kind of getting a better understanding of not only your usage, but your demand, the usage being the kWh number on your bill. I'd encourage folks to take a look at the kW number as well. That's your demand. That's something that if you can reduce that, you can reduce both the supply and the distribution side of your bill, two sides of the utility bill. When we talk about sustainability, I see we're running out of time here, folks, but the idea of being more efficient. LEDs are kind of considered the low-hanging fruit. A lot of folks have done that already. But if it's been more than 5 years since you replaced the LEDs, may not be a bad idea to take another look. There's utility incentives available. The lights last longer. It's a better quality of light. They're more efficient, reduce your usage even more. In some cases, as much as 25% of your total load can be reduced just by putting in LEDs, depending on your type of facility. And again, there's utility incentives out there, and a qualified energy consultant is going to get you the advantage of take advantage of all those utility incentives, help you get some of that money back that we're all paying for, quite honestly, little line items on our bill. Energy efficiency, overall, just the idea of updating old equipment, taking advantage of automation, maybe some heat recovery. Maybe it's just as simple as, the occupant sensors. When someone walks into the warehouse, the lights go on. A lot of little things can add up to some big reductions. And again, through our work with our solutions folks, we can make sure those things work in concert with your electricity supply agreement or your natural gas agreement, but also become more sustainable, more resilient, and take better, more control of your energy spend. Demand response, we see that in many different ISOs or independent system operators. And these are programs that basically pay you to curtail your usage, curtail your demand. Primarily on the hot summer days when the grid is under the most stress, there are programs both for the summer and the winter, though, that will pay folks to actually curtail their usage, curtail their demand, and be rewarded for that. Certainly a lot cheaper for a utility to pay you to reduce your usage than to build a new power plant in your area. So a lot of ways to take advantage of that. It's not for everybody. Not everybody can curtail, but for those folks that can, there's a lot of incentives out there to do that. And then this idea of on-bill funding. A lot of folks will say, hey, I'd love to put solar on the roof. I'd love to be more green. I'd love to, do these projects. I just don't have the capital expenditure to do it. I don't have the budget for it. We have means to do what's known as on-bill funding. It's no longer a capital expense. You can actually have that on your utility bill. Suppliers will finance these projects for you. There's a cost to it, obviously. We'll help you understand the pros and cons of all that. But in exchange for getting your electricity supply or natural gas supply, you may have the option to get some of those funds to help you do those projects, which ultimately help you use less energy and lower your expense that way. So great way to do it with no upfront capital and take advantage of some of those programs. Coming right in at about 11:30, couple here, folks, and I'll cut you loose. But again, we hope you'll consider working with APPI, or for those of you who already are, we thank you for your business. Again, we hope to take this holistic approach, be an extension of your team. We're in the energy industry day in and day out, whether it's negotiating contracts, trying to reduce your demand, trying to help you become more sustainable. All these things are available, and it starts with just a simple conversation. We'll get to know you a little bit better, get to understand your goals, your risks, what you're trying to accomplish, and then help all those things kind of work together to come up with a strategy for you to, again, help you manage your costs and reduce your costs as well. And with that in mind, I think Carrie, we are coming up right at about 11:30. Been talking fast here. I'm just going to go ahead and put my contact information here. You can visit our website at appiEnergy.com. Feel free to call or send me an email anytime. Either talk to you myself or put you in touch with the right folks on our end. But again, we really appreciate everybody taking the time to chat with us today. Happy to answer any questions either offline or at this time. But Carrie, a little after 11:30, I'm going to turn it back over to you if you have anything else to close us out.
Thank you, Dan. I do not see any questions at this time. Again, we appreciate you taking time today to join us. If you have any additional questions, please reach out to Dan or APPI Energy. Thank you.
Thanks, everybody. Have a great day.